You know, for nearly 3 decades, HDFC Bank wasn't just a bank. It was the bank, a fortress really, the undisputed golden boy of Indian finance. But today, that fortress is in the middle of a massive renovation, and its shield of invincibility? Well, it's definitely cracked. So what on earth went wrong? And what comes next? Let's break it all down.
And that right there is the million-dollar question, isn't it? We're going to unpack the whole story, the chain of events, the incredibly high-stakes decisions, and the one massive gamble that brought this financial titan to its toughest fight yet.
All right, so first things first. To really get what's happening now, you gotta look back at just how dominant these guys were. For the longest time, HDFC Bank wasn't just good, it was without a doubt the gold standard.
I mean, this was the perfect formula. Under its legendary CEO, Aditya Puri, the bank was just a machine, churning out 20% growth year after year like clockwork. And the secret sauce? An absolutely incredible 2% return on assets, which in the banking world is a huge deal for profitability. The strategy itself was this brilliant paradox. They were super cautious about who they lent money to, but absolutely relentless when it came to expansion. For investors, it was the closest thing you could get to a sure bet.
But you know how it goes. No dynasty lasts forever. And right around 2020, that shiny, polished armor started to show some pretty serious cracks.
It all started with a changing of the guard, when the titan at the top, Aditya Puri, finally retired. And then, bam, a huge blow. The Reserve Bank of India hit them with a ban on issuing new credit cards, all because of repeated tech outages. This was a massive public embarrassment, and it pulled back the curtain on a problem that had been festering for years, this thing called tech debt, which is basically what happens when you neglect your technology for too long. This forced the bank into an 18-month rehab period, and it gave rivals like ICICI a golden opportunity to close the gap.
And just when it seemed like the bank was getting back on its feet, it announced its biggest, boldest move ever. A move that wasn't just about ambition, it was about pure survival.
$40 billion. Just let that number sink in for a second. That was the mind-boggling size of the merger with its own parent company, the mortgage giant HDFC Ltd. And to be clear, this wasn't just some big acquisition. This move created, almost overnight, one of the largest and most influential banks on the entire planet. No exaggeration.
So you might be asking, why on earth take such a massive gamble? Well, it turns out it wasn't really about getting bigger. It was about survival. The old regulatory walls that used to separate banks from other financial companies were just crumbling. For HDFC and HDFC Bank, merging was the only strategic move left to compete in this totally reshaped financial world.
This move created the ultimate challenge. The merger forged this absolute behemoth of a company, but it was an elephant that now suddenly had to learn how to dance. I mean, integrating two massive organizations with two totally different cultures is an immense task. And believe me, the market was watching with a whole lot of skepticism.
Okay, so that brings us right to the heart of the issue, the big problem the bank is wrestling with today. The reality after that huge merger has been, well, a tough pill to swallow. And it's all defined by one single, all-consuming battle.
This chart right here tells the whole story. A bank's lifeblood is something called its net interest margin, or NIM. It's really simple. It's the difference between the interest it makes on loans and what it has to pay out for deposits. By absorbing HDFC Ltd's huge portfolio of home loans without getting a matching base of customer deposits, the bank's NIM got squeezed hard. It fell from a best-in-class 4.1% all the way down to 3.4%. And trust me, that one number is the source of pretty much all the pain investors have been feeling lately.
So what's the plan to fix this? Well, management itself is calling it a brutal slog, which tells you a lot. Step 1, they're basically sacrificing short-term profits to fund long-term growth. Step 2, they're waging an all-out war for stable, low-cost deposits from customers. And this means Step 3, an absolutely massive and rapid expansion of their branch network, opening something like 1,500 to 2,000 new branches a year. It's slow, it's expensive, and honestly, there's no guarantee of success.
As you can probably imagine, this whole situation has split investors right down the middle. There are two very clear, very different visions for where HDFC Bank is headed from here. So, in one corner, you've got the bulls, the optimists. They're betting on the bank's enormous size and its legendary skill at managing risk. They see a massive opportunity to sell mortgages to 80 million existing customers and believe those margins will climb back towards that magical 4% mark by 2026. But in the other corner, you have the bears. They see a brutal, hyper-competitive market that's going to keep those margins low. They're worried about the messy merger integration and the looming threat of tighter regulations hitting the bank right where it hurts.
Okay, so you've heard both sides of the argument. After weighing all that, what's the final verdict for you as an investor?
To really understand the verdict, you first need to get this term, a bedrock stock. This isn't about chasing fast, flashy gains. A bedrock stock is that solid, high-quality, reliable company that you use to build the very foundation of your portfolio for years and years to come.
So here's the bottom line. HDFC Bank is still a classic bedrock stock, a true compounder that can steadily grow your wealth over the long run. But here's the twist. After years of struggling, it's now trading in what you'd call value territory. This makes it a really intriguing option for patient investors with a 3 to 5 year time horizon. But it will probably frustrate anyone who's looking for a quick win. The one number you need to watch above all else is the loan-to-deposit ratio. Think of it as a health check. Once that number falls below 85%, that's a powerful signal that the turnaround is really working.
So yeah, the renovation is noisy, it's expensive, and it's far from over. HDFC Bank is rebuilding its foundations to be bigger and stronger than ever before. But in today's fiercely competitive financial arena, the ultimate question still remains. Will this renovated fortress be ready for the new wars that are still to come?